All right, let's just jump right into it. Banks, they're at the center of pretty much everything we do with our money, right? But for most of us, what actually goes on inside them is, well, it's a complete black box. Today, we're going to pull back that curtain and take a look at some of their best kept secrets. Think about that for a second. That's a pretty heavy statement coming from a former US president. It kind of sets the stage, doesn't it? It suggests that the way banking works isn't just some boring, complicated thing. It's something that deeply affects all of us, our money, and our future. And this image, it just nails the core idea we're talking about. Until you really get how the system works, you're a bit like this stick man, a puppet. The banks are kind of pulling the strings on your financial life, and you might not even feel it happening. But knowledge is what lets you cut those strings. So first up, let's look at the actual blueprints. We're about to get into the foundational secrets that make this entire system work. Okay, here's secret number one, and it's a big one. Your savings account is a much, much better deal for the bank than it is for you. Just look at the difference here. You put your hard-earned money in and get, what, maybe 0.5% in interest if you're lucky? The bank then turns right around, takes your money, and lends it out as a car loan or a mortgage, charging anywhere from 5 to over 20%. That massive gap in the middle, that's their profit, made using your cash. But wait, it actually gets worse. On top of that, while your money is just sitting there earning basically nothing, inflation is constantly nibbling away at it. Think about it. If inflation is, say, 3% for the year, and your savings account pays you 0.5%, you've actually lost 2.5% of your purchasing power. You're literally going backward. Okay, so let's move on to the next section and see how this all connects. Now, this part might sound a little bit like a magic trick, but it's the absolute core of how modern banking works, how money is basically created out of thin air.
The big secret is a system called fractional reserve banking. It sounds complicated, I know, but the concept is super simple. Banks are not required to keep all your money just sitting in a vault. They only have to hold on to a small piece of it, a fraction or a reserve, and they're allowed to lend out all the rest. Here's exactly how it plays out. You go and deposit $1,000. Great. Your account statement shows you have $1,000. But the bank, it only keeps 100 of that, and it loans out the other $900 to someone else. Now, that person who borrowed it also has $900 in their account. So get this, your original $1,000 is still in your account, and now there's another $900 out there. Just like that, your $1,000 became $1,900 in the economy. Money was literally created. So, the really mind-blowing takeaway here is that most of the money in the world isn't physical cash at all. It's just digital numbers on a computer screen, created through this process of lending. The entire system is built on one simple thing, our collective confidence that those numbers actually mean something.
And this brings us right to our next point. If money is created when banks give out loans, well, then that means our entire financial system is fundamentally built on debt. This is a huge mental shift. For you and me, debt is a liability, right? It's something we owe. But for a bank, your debt, your mortgage, your credit card balance is their most valuable money-making asset. They actually profit when you're in debt.
And this chart shows exactly why. Just look at the credit card cycle. When you only make that minimum payment each month, almost all of your money is just going to cover the interest charges. A tiny, tiny sliver is actually paying down what you originally owed. It's a treadmill designed to keep you paying them, generating a sweet, lucrative profit cycle for the bank for years and years.
So the system is basically a game, and it's a game built on debt. But here's the kicker. Not everybody is playing by the same rules. It's actually pretty straightforward. The more money you already have, the cheaper it is to borrow more money. Why? Because banks see a wealthy person as a very low risk, so they get offered the best, lowest interest rates. But for an average person, the bank sees more risk, so they jack up the interest rate. It's a two-tiered system that, frankly, helps the rich get richer by giving them access to cheap money to go out and invest.
So, knowing all of this, you have to ask yourself a really important question. When you walk into your bank and ask for financial advice, can you really, truly trust that they have your best interests at heart?
And the honest answer is probably not. Look, a bank's #1 priority is to make money for its shareholders, not necessarily for you. They're a business. So when they recommend a specific investment fund or a savings product, you have to remember they're usually pushing their own products, which might have hidden fees that are great for them, but not so great for you. Their advice is really just a sales pitch. Okay, so we've pulled back the curtain on the system. And yeah, it might feel a little discouraging. But here's the good news. Now that you know the rules of the game, you can start to play it differently. This section is all about how you can actually start winning. When you get right down to it, it all boils down to a very simple but really powerful choice. You can keep being just a customer of the bank, or you can decide to become an owner. And this, right here, is the real game changer. You can completely flip the script. Instead of just giving the bank your money so they can profit from it, you can buy shares in that exact same bank. When you become a shareholder, you get a cut of their profits through dividends, and you make money when their stock price goes up. You're no longer just funding the system, you're actually profiting from it. So, let's wrap this all up into a clear, actionable strategy. Step 1. Go after your high-interest debt like it's your mortal enemy. Step 2. Stop letting piles of cash lose value in a low-yield savings account. Just keep what you need for emergencies in there. And step 3. Invest everything else in assets that can actually grow faster than inflation is eating your money away.
And this brings us right back to where we started, with our little stick man. The knowledge you have now, that's your pair of scissors. By understanding these secrets, you've empowered yourself to take control, to finally cut those strings, and to start making your money work for you, not just for the bank. At the end of the day, it's not about being angry at the system, it's about understanding it well enough to make it work for you. So the final question isn't for me, it's for you. Now that you know the rules, how are you going to play the game?